Thank you, Shivani. At the outset, let me thank the chairman of Vigata, CA Chandak sir, chairman of Direct Tax Committee, CA Ketan Sayya sir, and all the participants present over here despite the evidence. I had a chance to call up the WRC team in the morning and ask whether the session is actually on or it had been called on. To get the this one, we kept on checking the yeah, so actually this session was planned on 6th of July, then it got postponed to 13th of July, and finally it is held on 20th of July. So in the morning, I happened to call up them and ask them whether the session is on because the rains are pretty heavy and generally you feel a lot of waterlogging at multiple places. So I think all of you are present over here. So big kudos to all of you. Sincere thank to be present over here and showing your interest to relearn the subject. As rightly pointed out, income tax, we need to keep on relearning a lot of things, a lot of changes, a lot of amendments, a lot of precedents that keeps on coming in. So with this objective, this session is having time. One session has already happened. This is the second session on the relearn series. The topic which I would allotted to me is income under business and profession, provisions and practical issues. With the August audience which is there, I think most of them are seniors. Most of them would have are much better in terms of knowledge on business and profession than what knowledge I might possess. But still, I will try and attempt to give whatever best inputs that are available with me and share all of that with all of you. What I intend to cover today is a brief overview of the provision. So, because it's the dealer, we might touch upon a lot of basic concepts, try and have a basic idea as to whether the basic concepts are still intact or no, definitions of business, profession, certain incomes which are capable of falling under multiple heads. So we try and discuss whether this income would be business income or say IFXT or capital gains or IFOS. And the focus during this course of presentation would be on sections and provisions which are impacting computation of income. So there would be a lot of provisions under the chapter 4 part D, which is dealing with business and profession. However, during the course of presentation, you will be very specifically dealing with only those sections which are affecting the computation of income. And finally, the key takeaways which are there from the today's session. As you all know, profits and gains. One is income, deduction, third is the allowance, and fourth is the loss. There has to be an income. Income will be either taxable, non-taxable, depending on the provision. So generally, Section 28 provides which are the list of income that are taxable. Something which is not covered by Section 28 would form part of non-taxable category and would not be taxable under the provisions of business profession. For deduction, again, there are two buckets, allowed, not allowed. Something which is very specifically allowed. So you have Section 30 to Section 36, which says that following expenditures, if incurred by the assessee during the previous year, then would be allowed as a deduction. So Section 30 to 36 allows only specified deductions. And then you have Section 37, which says that any expenditure which is not covered by 30 to 36, and if it fulfills the criteria, that is, it is not a capital expenditure, it is not a penalty or fine, then it would be allowed under Section 37. So 37 is like a residuary provision. Expenditure which is incurred for the purpose of business, not covered under 30 to 36, would be allowed as deduction. Then you have a category of deductions which are not allowed. So you have specified sections 40 to 43B. It tries to state that assuming TDS has not been deducted, cash payments are done for more than 10,000 rupees. All those categories are there. Even though the expenditure is incurred for the purpose of business, it would not be allowed as deduction. Provisions which are there under the Act, which are like an anti-abuse provisions. And then you have generally not allowed. So you have 37(1) where it says that any expenditure which is an offence or prohibited under the provisions of law, then though it is incurred for the purpose of business, it would not be allowed as deductions. Then you have a category of allowance. So everybody is aware that in terms of capital expenditure, what we are allowed is an allowance and not an expenditure. So any capital asset that you purchase, you would be allowed a depreciation allowance, and similarly for investment allowance. Finally, the concept of loss. So, well accepted principle that income includes loss. In terms of loss, loss can be bifurcated into two categories. One is revenue loss and second is the capital loss. The revenue loss would be allowed as deduction, capital loss would not be allowed as deduction. So, brief concept of the business and profession narrated in this flowchart. So this is something that section wise that what we are dealing. So, charging section is section 28. Section 29 says that income of business and profession. For completing the income and profession, the deductions under section 30 to 36, 30 to 40, 44D would be allowed business and profession. Then as we spoke, disallowances of 40, 40 and 43B. Then you have maintenance of books of account under 44AA, the tax audit provisions under 44AB, the scheme of exemptive taxation which is from 44AD till 44DB. So you have specified provisions for non-residents and cooperative banks. We will be dealing till disallowance part. The rest of part from maintenance till presumptive is something that we would not be covering in the course of today's session. Now coming to the definition of business. Business includes any trade, commerce or manufacture or any adventure or concerning the nature of trade, commerce or manufacture. So basically definition is provided in section 230 and the legal precedents are held that the landmark judgment of Barendra Prasad Roy where it was stated that activities carried on continuously and systematically with intent to earn profit would be regarded as business. So if you are doing activity which is continuous and systematic, but with not an intent to earn profit, it is just like a gratuitous act without an intent to earn profit, then this will not be considered as a business activity. So for business, all the elements should be present. Only then the income will be chargeable to tax under the head business profession. Otherwise, it might fall under the head income from other sources. So these are the two landmark judgments. The Delhi High Court has held us to regard an activity as business, there must be a course of dealings continued or contemplated to be continued. So not necessarily that it is on a continuous basis. The intention should be that the activity will be carried out on a continuous basis with an object of making profit and not for support or pleasure. So intent of making profit is very much essential. Even if you incur loss, that is okay, but the intent is always to be there to earn profits. Now we will look at the definition of business. It includes one concept of adventure in the nature of trade. This is the concept where I think most of us generally neglect this provision. But there have been a lot of judicial precedents on the terminology of what is considered as adventure in the nature of trade. Would anybody like to highlight what it means, or I think most of the seniors would be aware, but if still anybody want to give it an attempt? Let it be interactive because it's a relearning session. So I think most of us sitting over here are already well versed with the subject. So active participation would be much more. To earn profit. Okay. So that is already there under the concept of business. So why you require adventure in the nature of trade? Some project, okay. 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 So I think the concept which has been brought out by the judicial precedent is that there would be multiple requirements under the definition of business. It has to be continuous activity, contemplated to be continuous with earning, intent to earn profit. So there are multiple requirements to be fit under the category of business. If you don't fit all the categories, but part of the categories are fulfilled, then it would be considered an adventure in the nature. So that is what the concept or principle is something which has been brought in. We look at this, the Supreme Court decision where it says that a transaction that is characterized by some of the essential features of trade or business. So not all features of trade or businesses are present, but there are some of the essential features which are present, but not all of them. So even an isolated transaction can satisfy the description of adventure in the nature of trade. So even though there is not a continuous activity, it's one-off activity, still the transaction would be regarded as business transaction and would be subject to business provisions and not capital gains provision. So as rightly pointed out, I intended to develop something, so it would not be capital gains, but it would be business income. Also, what is relevant is intention to purchase. The time when I bought that asset or I did that transaction, it is not at the time of sale. So if I bought an asset with an intent to trade off, but then later on I said, I want to hold this asset, I will see what is to be done after 5 years, then probably this might be a capital gains. But if the intent at the time of purchase was always to sell this, then it is business income. So at what point of time you have to look at intent? Intent has to be looked at the time of purchase and not at the time of sale. So let's have a question over here. An SSC has purchased plot with sole intention to sell them at a profit. Whether this can be considered as adventure in the nature of trade? I have purchased some plots with intent to sell at profit. Only one plot with intent to sell off. Whether can be considered as an adventure in the nature of trade? Generally, we treat all these transactions with developing or without developing. Without developing. Can it not be a return on the capital gain? That is what I was coming with. Generally, we treat this transaction as capital gains, and which has been accepted by a lot of judicial presidents also, and principally also. If I will return the buy a plot of land with an intention to make an investment, long-term investment, some 3 years, 5 years, and sell. So that is where the intent is at the time of purchase and not at the time. So I intend to hold on for 3 years, 5 years, then it's capital gains. But intent was to immediately trade off. I buy it today, 5 days I sell it off. Then whether this is capital gains, short-term capital gain, or business gain. So courts have held that if intent was to trade off immediately, then yes, it is business income and not capital gains. Also, in few of the precedents, it has been held that your intent was to buy and sell off, and for that transaction, you have borrowed money. It is not your own surplus funds that you are investing, it is you have borrowed, you have put in, money has come and you have repaid the loan. This is pure business transaction. We generally treat all these transactions as capital gains. But this is what the precedents have held, and we had a couple of orders where the department has tried to argue why the particular transaction should not be regarded as adventure in nature. So very critical to analyze the concept of adventure in the nature of trade. I think most of us will try and ignore this, but it's something which is very basic and very fundamental. The definition, which is more important when you are borrowing and investing in share. That is being considered as. So for share market, sir, there are specified circulars. I think we'll come to that. So share market we treat it separately because there are instructions. There are two security circulars which have already been issued. The department has held that if SSC is treating that as long-term capital gain, charging it as capital gains, you accept it. There will be no addition which will be. We'll come to that at subsequently. Profession defined in section 236, do subsection 36, it says it includes vocation. However, vocation has not been defined. And the Supreme Court has held that profession involves the idea of an occupation require purely intellectual skill or manual skill controlled by the intellectual skill of the operator. So it is more person-driven activity that would be considered as profession and not the activity which has been done cumulatively. So take an example of a doctor who is providing his services. If he is providing services under his own proprietorship, then probably it would be like professional income. But if he is setting up an hospital and trying to provide a services where multiple people are involved, there will be non-professional, professional, everybody involved in executing that services, then probably that would be considered as business because it is not only his personal and intellectual skill that is driving that income. So you need to evaluate whether the income per se is fitting under that category or not. Now coming to section 28, which is charging section. Section 28 has 7 limbs, 7 clauses which are there. Basically, first, profits and gains from business profession. Assuming you receive any compensation or termination of any contract, any income that you receive would be chargeable to tax as business income. Non-compete fees. So assuming you agree not to do any business activity and you receive any money for that, then that would be again chargeable to tax as business income. Benefits and perquisite, a very hot topic. Post the amendment to 194R, what all things would be constituted as benefits and perquisite. Though it has not been defined under the Act, but the circulars are laying down certain guidelines and there are judicial precedents which have held that what would be considered as benefit and perquisite. And another critical amendment which was made few years back is conversion of stocking trade into capital asset would be chargeable to tax at the fair market value. 28 clause 6A. I think this is again a very critical clause that needs to be evaluated. And assuming you receive any assistance under the export scheme, so DEPP licenses or any other income that you receive. So all the receipts of such category would be classified as business income. Just breaking down the section 28. Section 28 says there should be a business or profession. We look at the definition, what is business, what is profession. The business has to be carried on for some time during the previous year. What is previous year? We will come to the definition. So business has to be carried on during the previous year. The charge is in respect of profits and gains of the previous year. So whatever profit that you accumulate for that year would be chargeable to tax, and it extends to business profession. As we looked at the definition, the pertinent test is the intention to earn profit. So if there is no intention to earn profit, it is or a selfless job that you are doing, then probably it would not be considered as business. There is no concept of notional profits being charged to tax. So you have deemed let out property concept under IFHT. There are no similar concepts which are present under the business chapter. It's all real income that is subjected to tax. The actual income that is realized subject to 43 CA and all other section, but that's a living fiction. But notional income, there is no concept of notional income over here. Also, all your illegal income would also be subject to tax. So whether your business is permitted business or not permitted business, that is not relevant. Any income which is derived from business activity, be it legal, non-legal, would be subjected to tax. Previous years, so section 28 says that business and profession should be carried on by the SSE for some time during the previous year, and profits and gains in this for that previous year would be subjected to tax. So what is the definition of previous year? Previous year says that for business which are newly set up, the previous year shall be the period beginning with the date of setting up of the business and ending with the financial year. So what is critical? When is the business set to be set up? Generally, previous year we consider 1st April to 31st March as the previous year. So this will be different in case of the SSEs where there is an amalgamation, demerger or new business. And there are two concepts. One is setup of business and one is commencement of business. Anybody would like to throw light what is setup and what is commencement? So setup is the first and not the commencement. Okay. Anybody else would like to give it a try? Company is formed but not commencement. So commencement is immediately nowadays. Under the Companies Act now, you cannot start your activity unless you have a commencement certificate. So I think your all other activities also cannot be done. So the principle, what we mean by setup of business, has been laid out by a series of decisions, and this has been a very hot topic in the judicial forums for some larger entities. It says that business is set up when major activities are completed and necessary infrastructure required for commencement of the business are in place. So not necessarily that you have actually started your business activities, but the necessary infrastructure which is required for you to start your business are in place. That is the time when the business is set up, and from that date onwards, any expenditure that you do for the purpose of business would be allowed as deduction. So any expenditure that you do prior to that date of setup would not be allowed as deduction. So very important for you to analyze. There are host of judgments which are there. Ramaraju Surgical Cotton Mill says no setup till last of the activities needed for commencement of businesses are completed. So if all there are multiple activities that are required, then till the time last activity which is required for commencement is not completed, your business is not set to be set up. Delhi High Court says that earnest money paid for acquisition of land is equivalent to setup of business in case of a real estate company. So this decision was in the context of real estate company. So very important for you, all of us, to analyze this. What is the concept of previous year? So definition actually is very critical in the first year. First year. So first year, or in case there is an amalgamation or demerger of the company. So demerger, generally the business will start as it is. So otherwise, generally for companies which are very freshly incorporated, I think this is very critical. When I was at PwC, we had an instance where we had worked on one of such instance, and we decided quite a sizable amount of considering that the business is not set up and this amount will get discovered. So the amount was quite large, and that is the time when we realized that the importance of the definition of previous year is quite significant. Generally, we try to ignore this, but I think this is something which is very important. So it depends on the activity. So assuming you have to this the date of setup. So in that case, if the activities generally in case of amalgamation demerger, the activities would be running. So from day one, probably they'll start doing a lot of business. Amalgamation and demerger should not be a lot of issues, but most pertinent would be for the newly set up companies. Is it answering your question? Just a question, right? There is a specific place that or there are also certain specific places for different industries, different kinds of yeah, there are many. There are a lot of decisions. Because in the manufacturing setup, there are very critical milestones which are visible. Correct. Plant is ready, commissioning, there are various milestones. So in case of mining, what I recollect, there was one decision which says that if I started in the tendering process, I started evaluating various mining proposals which were there. I set up a team, I hired consultants. At that point of time, I would say my business is set up. So when is it that set up? So depending on this is more factual activity which would be there. We'll have to evaluate this on case to case basis. Now coming to incomes where there is a potential of it falling under multiple categories. So the same set of income could be classified as business income, and there is a potential that this could be also classified as a house property. Everybody will be aware, so I would like to try and invite some suggestions from all of you. Whether merely letting out of commercial property, does it make a business income? So I have a commercial property. Business. It's purely because purely what I'm doing is just letting out of the property. But if I'm continuously engaged in that activity, there are multiple properties, and my whole intention is to only earn the rental income, then this would take the character of business income. You have to see whether this is the major source of income of the SSE or not, or this is only a small amount in the overall scheme of things that the SSE has. So, assuming SSE has 100 crores, out of that, if 5 crores is the rental income, balance 95 is business, then probably this would be considered as IFHB. But if it is the reverse way situation, 95 being the rental and 5 being the other interest income, then probably this would get characterized as business income. What are the main objects of the SSE? The company is formed or the partnership is formed. What is the main intent with which the activity has been carried out? Or what is the main purpose for which the entity has got incorporated? I think that would be very relevant for you to determine whether the income, the characterization of income. For this, we have three landmark Supreme Court judgments. First is Chennai property, followed by Rayala, and finally the Raj, Dadadkar and Associates. All three Supreme Court decisions. In the first two decisions, it was held that this would be considered as business income. Last decision, which distinguished Chennai properties and Rayala, it was held that the income would be categorized as house property income. However, the facts in all the cases are different, so you cannot pick up the final last decision and say, okay, I follow the Raj, Dadadkar and Associate, and the income would always be house property. You need to look at the facts of your case and try and see which of the cases is what you are fitting into. For ease, I have bifurcated this into what was the main object of Chennai property of all these decisions, what was the actual activity that they were carrying out, what was the actual income that they were earning, and how was it assessed. So, Chennai property rental income was the only income. The court held this was business income. You did not have any other activity. Your main intention was to put properties on rent. Rayala, again rental income was the only income. They were dealing into real estate and the object was to earn rental income, where this is again business income. Raj Davarkar, again the intention was to put premises on rent and sublet it. However, there were multiple streams of income. Compensation from sub-licensees, legal license fees, service charge for providing services such as utilities, securities, etc. The court held that this income would be treated as house property income because there was no evidence that the entire or substantial income was from letting out of business. So because there was no evidence which was there, that is what has been held in the judgment. Whether the letting out income was the major source of income, on that premises they held that this would be considered as house property income and not business income. So very critical for all of us. Maybe each one would have different facts.
Correct. One second.
Sorry.
When it is subletting of income, normally it will form part of the other sources.
Correct, because the property is not owned by you. So one of the requirement for income to be classified under house property is that the property should be owned by the SEC. So in this case, the maybe we are not very sure on what would be the facts of that case, but based on whatever limited facts are available, it has been held that house property income, because there was no other income. The other income was much higher than the house property income. On that premises, they have taken that position. Business versus capital gains. So we were pointing out what about shares, stock in trades. First of all, whether dealing in shares through a PMS is a business. I think because the last 2 years we have seen a bull run in the market. A lot of people have invested in the stock markets through PMS or they have done independent trades. I don't think so. So again in PMS there are two PMSs. One is discretionary and non-discretionary. Discretionary is where you put on the entire onus on the portfolio manager to do the business. I think there have been judicial precedents which have held that this would be capital gains and not business. More so even if you have 5-6 PMSs, I think that principle would still survive. Very famous controversy whether this is stock in trade or investments. If I'm doing multiple trades in shares and securities, whether the income from the activity that I'm doing would be categorized as capital gains income, short term, long term, taxable at a lower rate, vis-a-vis business income, which is taxable at a higher rate of 30%. Firstly, we have an instruction of 1989, followed by a circular of 2007, followed by a circular of 2016. Finally, what 2016 circular says that if assessee is opting for business income, you accept it. You don't challenge it. We don't want litigation. If assessee is saying this is my business income, you accept and close the chapter. In case of a long-term gain of a listed security, this is only for long-term gain of listed security. If assessee is treating as capital asset, then also you accept it. You don't challenge. It's taxable at 10%. The department will not challenge you. You will go as 10%. For short-term gain, there is no clarity. For short-term gain and all other gains, they say you have to follow the principles which have been laid down in the instruction dated 1989 and the circular dated 2007. So, which of the principles you are setting, whether if you are fitting under those baskets of business, then it is business income. If not, then it is capital gains. One relevant decision that I would like to highlight is in one of the case, it has been mentioned what treatment that you are giving in the books of account is very relevant. So if in the books of account you are yourself classifying this as stock in trade, then obviously the income would be classified as business. But if you are classifying this as investment, then probably this would be like an investment income. The importance, high amount of importance has been given to the characterization in the books of accounts. So capital discretionary payments we already saw. There is a Delhi High Court judgment. Shares sold frequently after short duration of holding. So my intention was always to earn quick money. I bought today, sell tomorrow, bought today, sell tomorrow. Multiple trades. Characteristics of the assessee was he was doing thousands of crores of turnover on a daily basis. So they said this is business because you can only earn quick money. It was not appreciation that you are looking for. You are looking for quick realization of money, and this would be classified as business income. Whether assuming I have shares of Reliance, whether I can have Reliance as stock in trade also and investment also? Court says yes. Assuming these shares are kept into separate demat accounts. So in demat 1, I have shares of Reliance which are classified as stock in trade. Demat 2, I have shares which are classified as investment. That is perfectly permissible. If the object of the firm is to purchase and sell land, then profit is to be considered a business income. So my object at all point of time was to purchase and sell. There was no point, no thought process of holding that land for a longer duration. As we saw in the earlier discussion, adventure in the nature of trading. This is something by virtue of that, this would be classified as business income. Now, business income is other sources. So for interest income, we have generally three options. Assuming there is a work in progress which is going on and you have interest income, you might try to reduce your interest income from the work in progress, or you might offer this as business income. Or the third option is you might offer this as income from other sources. So depending again on the factual matrix of each case, probably you'll have to decide whether this is to be reduced from the cost of asset, whether this has to be offered as business income or has to be offered as income from other sources. Let's look at few examples. Interest on FD from excess fund generally would be income from other sources. No question over here. Interest on fixed deposit to secure bank guarantee to acquire contract work. So FD has been put specifically for earning some business income. Otherwise, I would have not done this FD. Then I can take a position that this is nothing but a business income because I did not intend to put this surplus money as an investment. This was purely done for the purpose of earning business income. Similar logic would apply for interest on margin money to obtain business license. Interest on advance to contractor engaged in construction of plant. In this case, they have held that you can reduce it from the cost of assets. So depending upon the factual matters, and interest on income tax refund would always be income from other sources. Dividend income for stockbrokers. So if a stockbroker, generally they have two accounts. One is the proprietary account and one is the investment account. If you are prop account, whether dividend that you receive on your prop shares would be classified as business income or dividend income. Any answers? Ideally, it has to be business income because the intent was always to earn quick profit, and in earning that quick profit, there is some incidental income that is going to me. And generally, when I do a prop trading, proprietary trading, I factor in my dividend in my profit and loss also. So with that intent, I'm doing this transaction. So generally, it has to be classified as business income and not dividend income. And subleasing of premises, as you rightly pointed out, subleasing would be other sources and not house property income because I am not the owner of that property.
Just one question here. So if I have a existing FD or excess funds, this cash flow property, and then I use that to secure primary, is the nomenclature change? Is the option available or something else? If we have small entity and not consider not
I would tend to believe that there have been multiple decisions which have held that the purpose of putting in FD was only to secure some business contract or business license. Otherwise, I would have not done this fixed deposit. Then yes, this would be treated as business income, not income from business.
no, I was very particular never existing FD.
Still,
Still,
yeah, because now you are earmarking that to a particular business income. So
so I switch.
you switch that
Yeah, exactly.
because the character changes at that point of time. So I think these are very fundamental. The objective is to have a thought process in it.
If they are having sublinking of premises, then section 24 will not be that standard deduction.
So generally no, because for income to be classified under income from house property, it has to be owned property. If it is not owned, you don't go into house property, you go into other sources. And that is a fundamental principle which is now coming to benefits of purpose. Hearing now with 194R, probably we might need a separate one day session to just analyze what we mean by benefit and purposes. Not going much into the detail, I think the slides would be available with you. Now, with the amendment in the Finance Act 2023, any benefit or perquisite, whether received in cash, partly in kind, would be regarded as perquisite. But the important point is that the benefit or perquisite has to be arising from your business and profession. So if there is no business activity, it is not arising from business and profession, then this would not be classified as benefit or perquisite. This would be like either a capital receipt or taxable into section other sources. I think that is the critical point which I wanted to highlight in this subject. The term benefit or perquisite has not been defined. However, there are a lot of judicial precedents which have held that how do you interpret the term benefit or perquisite. So, one of such tribunal decision in this, they say that the word benefit has to be interpreted in the same manner. That is, at the time of execution of business transaction, the one party should give to the other some irretrievable benefit or advantage. So there is some benefit or some advantage that is flowing to you on account of some business transaction. If that be the case, then it would get classified as benefit or perquisite chargeable to tax under section 28 clause 4. Again, some other decisions which have held the concept of what do you mean by benefits or perquisite, whether this is taxable under 28.4 or no. Mahindra and Mahindra now overruled by Finance Act 23 because they had held that whatever is the cash received is there, it is not subjected to tax under 28.4. Now overturned. Wheels India, it says that capital receipts does not fall within the ambit of section 28.4. So again, the question would be whether it is only revenue receipt or sales receipt or capital receipt. Only revenue receipts have to be considered for 28.4. So we need to again go back to the principles whether the income that we are talking is falling within that limbo or no of 28, section 28. Whether per se it is income or no, if that's an income, probably the distinction between capital and revenue receipt has now been done away with. So whether capital receipt or revenue receipt would be chargeable to tax under 28.4. Purchase of goods or assets at the price which is lower than the market price. 100 rupees worth of cost of goods, you are getting it at 90 rupees, other 10 rupees would be considered as benefit perquisite. The circular says yes, but then it says practically we will consider 90 rupees as the cost and there will be no taxability under 28.4 for that balance 10 rupees. Receipt of car for promotion of NDTV Toyota Greenathon campaign as a brand ambassador is taxable. She was a brand ambassador and she received some benefit in the form of car and it was held that this is subjected to tax. Shah Rukh Khan received some villa out of natural love and affection without any brand endorsement, so he did not do any activity. There was a free flow of natural love and affection and the villa was gifted. It was held that this was not arising from his business or professional activity and therefore this would not be covered with the 28.4, could be subjected to tax under 56. Again, few questions on benefit or perquisite is whether interest-free loan to a operating subsidiary. So, if I have an wholly owned subsidiary, if I am giving interest-free loan, whether this amounts to benefit or perquisite, technically yes, it amounts to benefit and perquisite. And how do you comply with provisions of 194R? I think most of there would be a lot of complexities when you deal with 194R with 28.4. These are few thought processes which need to be taken into consideration when you are applying in your daily basis. I would like to spend more time on this because this would be more relevant for all of you for the particular season, unless this gets reversed on Tuesday in the budget. So, till the time it doesn't get reversed, let's have a thought process on it. 43B generally allows reduction of expenditure on payment basis. So, it says that any expenditure which is otherwise allowable would be allowed only if the payment is actually done. If payment is not done, then the deduction would not be allowed. A new clause H has been introduced where it says that any sum which is payable to micro or small enterprise beyond the time limit which has been prescribed under the MSMED Act would be allowed only on payment basis. What is critical is the definition of micro or small enterprise. So any payment to micro or small enterprise, if done payment beyond the time limit prescribed under the law, it would be allowed only on payment basis. What are the time limits? The time limits are here. Assuming there is an agreement between buyer and seller, then they say that agreement would prevail. And if there is no agreement, then before the appointed date. Then there is proviso to that clause. It says that even if you have an agreement, the maximum time period is 45 days from the date of acceptance or 45 days from the date of deemed acceptance. Now there are three terminologies which are involved. One is appointed date, second is day of acceptance, third is day of deemed acceptance. We need to understand all the three terminologies to understand this provision. And the another answering thought is that 43B generally allows payments till the date of return filing. There is a proviso that it till 139(1) if you have made that payment, then you will be allowed that deduction. However, that benefit has not been extended to clause H as on date. It might be, it might not be. And this will be applicable to all taxpayers. So irrespective of whether you are subjected to tax audits or not subjected to tax audits, if you have income under the head business and profession, then these provisions will be applicable. So even for the returns that are getting filed on 31st of July or the due date is 31st of July, these provisions will be applicable. Now let's look at these three concepts. What is appointed date, day of acceptance, and day of deemed acceptance. First, date of acceptance. They say actual delivery of goods or rendering of services. That would be the date of acceptance. And in case you have raised an objection, so if buyer has supplied the goods and supplier has raised an objection, within 15 days of supply. So say I supply goods on 20th of July, on 25th of July supplier raises an objection. Then the day on which the objection or whatever clarification that you wanted in the improvement in the goods or services, the day when I remove that objection, that would be considered as day of acceptance. So 20th July, 25th July he raised an objection. So the day, assuming 31st July I remove that objection, then 31st July will be considered as date of acceptance. But if I supply on 20th of July, he raises an objection on 10th of August. Then 15 days from 20th July, 5th of August will be considered as date of acceptance. Sorry, 20th July will be considered as date of acceptance, not 5th of August. The extension of 15 days is only when he raises an objection. Otherwise, it is the day on which the actual goods or services have been rendered. Day of deemed acceptance. So, assuming he doesn't raise an objection, then the actual day of delivery of goods or rendering of services. An appointment date means a day of 15 days from the date of acceptance from buyer from a supplier. So maybe just to repeat, date of acceptance, date of deemed acceptance is relevant when you have an agreed contract between the parties. If I raise an objection within 15 days of date of supply of goods or services, then the day on which I remove that objection will be considered as day of acceptance or deemed acceptance. If I supply the goods and he has not raised any objection, then the day when I actually supplied the goods would be considered as date of acceptance or deemed acceptance. In case of appointed date, which is there is no agreement which is there, in that case, again the actual date of supply of goods or services, the same concept would apply over it. However, one need to take care that maximum period is 45 days and not beyond. And we have a definition of MSME, investment in plant and machinery. So what would be considered as micro enterprise and what is considered as small enterprise. Let's look at some examples over here. I think this would be making it much more clear. First scenario is that liability is incurred in March 23. Due date of payment is Jan 23. Actual date of payment is Jan 24, which is much beyond the time period which has been prescribed. Whether 43B clause H applies. As of now, just look at view 1. View 2 we will discuss subsequently. Because the provisions are applicable from 1st April 2023, any outstanding payment as on that day would not be covered by this provision. So you can make those payments at any point of time. That would be allowed as deduction. In scenario 1, the deduction will be financial year 22-23 itself. Scenario 2, the liability is incurred in financial year 23-24 is the year in which this provision is applicable. The due date of payment is October 23. The actual date of payment is Jan 24. So you have made the payment beyond the time limit which has been prescribed under the MSME Act. Technically, there is a disallowance and the allowance in the same financial year. Generally, nobody shows this disallowance and allowance. We generally take it on the net basis. So there will be no disallowance for that year, and the deduction would be allowed in financial year 23-24 itself. Scenario 3, due date of payment is, so year of incurrence of liabilities. I purchase goods in financial year 23-24. The due date of payment is 5th April. I make payment on 5th of April. Then, because the payment is done within the time limit which has been prescribed under the Act, there would be no disallowance. And the deduction would be allowable in financial year 23-24 itself. Scenario 4, year of incurrence of liabilities, financial year 23-24. Due date of payment is 5th April. I make payment on 1st of May 2024. Now, due date was 5th April. I made payment on 1st May. Technically, there has to be a disallowance which has to be there. If you read the language of the section, that is how the interpretation goes. However, there is a view which says that amount has to be due as on 31st of March. So when we say that the time limit as per MSMED Act, if you look at the provisions of clause H, it says that to provide any sum payable to micro or small enterprise beyond the time limit specified in the MSMED Act. So there are some legal firms and some firms which have been taking a position that as on 31st of March, this amount should have been due as per the MSMED Act. If as on 31st of March this amount was not due, then provisions would not apply. Then the disallowance will happen in the next financial year, which is financial year 24-25. But practically this will not work because in March, year of incurrence of liability was financial year 23-24. You have already debited this to your profit and loss account. You have already claimed this in your profit and loss account. How will you disallow in financial year 24-25? But still the firms believe that there is a possibility of some amendment in the provisions where they will try and provide that this was a clarificatory amendment and probably this should have got disallowed in financial year 24-25 and not in 25. As on date, the way provisions are, I would feel view 1 is the better reading of the provisions. However, people who want to be aggressive and creative would claim the view which is taken by a lot of bigger firms in view 2. The logic over here is that liability has to be due as per the MSMED Act as on 31st of March. If as on 31st of March the amount was not due, then the provisions are not triggered. So we are treating that even the amount is due after 31st of March and I make payment, then it is covered by the provisions. If their proposition is that amount has to be due as on 31st of March, if it is not due, if it is getting due in the subsequent year, I will test in that subsequent year. I will not test this. So that is the logic which is there. Now, few related questions to MSME payments. Whether these provisions would apply to charitable institutions. I think everybody would be aware. No. Charitable institutions have a specified code in itself. Disallowance would applicable for MAT computation. Again, no. Disallowance be applicable in relation to capital expenditure. No. Answer is already written, but any view why no? Anyone? It's not an expenditure, it's an allowance. So what 43B disallow is an expenditure. What you get for depreciation is an allowance. With that rationale, it would not apply to capital expenditure. Assuming the payment is done, there are two provisions that are getting triggered. There is a non-deduction of tax, and there is non-payment to MSME within the specified time limits. Disallowance would be 130% or restricted to 100%. So I made payment to a professional, he is covered by MSMED Act. I failed to deduct TDS, so there is a 30% disallowance under 40A. 100% disallowance under 43B. Total disallowance of 130 or restricted to 100? Ideally 100. So how the 100 will enter under 43B or 37B? So it was a 30/70 because you reach to 43 after 48 and 43 says that any expenditure which is otherwise allowed. So under 48 you already disallowed 30 rupees. Balance what was allowed was only 70 rupees. Because that 70 rupees is something that is not paid within the time limits, 70 rupees will get disallowed under 43. The maximum disallowance will be 100 only, but will get split into 40A and 43B. Provisions apply to trader registered under MSMED Act. So I supply a goods to trader. Provisions are applicable, not applicable because benefit was granted only for that specified purpose of priority sector lending. No other benefit is granted to traders. So if the registration certificate says that he is a trader, then probably you might not cover that party for 43B disallowance.
Third case, whether the depreciation allowance will be effective?
No, sir. Because it is not governed by 43B. Depreciation allowance is section 32. They don't say expenditure or allowance which is otherwise allowed. And under 32, once you have capitalized it, when an asset is put to use, there's a specific provision in section 32 that depreciation is mandatory. If they wanted to curb this, there is a specific provision, say similar provision is there in 48(3), where you do a cash payments, then equivalent amount is not allowed as deduction from that capital cost, from the actual cost, 43. So assuming say I buy a capital asset for 25,000 rupees, everything is in cash. They say actual cost of asset will be 10,000 rupees because anything which is paid beyond 10,000 is not allowed. So 43 restricts the cost of asset and the depreciation would be allowed on 10,000 only. But similar provision, there is no amendment in 43(1) which says that in case of such payments, there would be a disallowance. Ambiguity on the point of time to check the registration status. So a lot of people have surrendered their MSME registrations because the buyers were complaining that we don't want to do business with you. In that scenario, how will you do so? Whether the registration status has to be checked on the day of transaction, start of the year, or at the end of year. Ideal scenario is the day of transaction, the party has to be registered. Practically very difficult. Generally, we tend to believe if the registration certificate is there, probably we try and accept it. But very technically, it has to be the day of transaction. So again, the next point, it surrenders registrations before the end whether disallowance attracted. You might take a position that disallowance is not attracted because the party is no more registered. But very technically, as we saw, it has to be on the day of transaction that has to be seen for applicability of this provision. Year-end provisions, whether would be subjected to 43B. So I have just provided there is no actual rendering of goods or services, or maybe there is no completion of that goods and services. Part has been supplied, part is pending. I have just done provision in the books of accounts based on the approval consent. Probably I would take a position that this would not be covered by 43. However, in the garb of provisions, you cannot convert all your liabilities, sundry creditors, balances to provision. So be cautious of that. Whether the disallowance would be inclusive of GST or exclusive of GST. So 100 rupees plus 18, 118. Disallowance is 100 or 118. Has to be 100, cannot be 118 because that is 100 is the sum which is payable to the MSME. It is not 118. 18 rupees is payable to the government. Disallowance would be gross of TDS or net of TDS because on that 100 I would have deducted 10 rupees. 90 is now payable. So 90 or 100, 90 because 10 rupees is already deposited with the government in form of TDS. So I think provision looks very simple. The applications looks lot difficult.
Giving the TDS is also paid.
Otherwise वो वहाँ पे disallowance आ जाएगा. Non payment of TDS में disallowance आ जाएगा.
But in case of VAT, it should be 180 or 100. So 80 is also able to MSME.
No, it payable to MSME, but the liability, it is a government. Sir, I am not a principal for that money. I am acting as an agent. My job is to collect that and pass it on to the government. Though that sum is payable to the SSC, but technically for the rendering of goods and services, उसका income कितना है 100 rupees. What is his share? 18 rupees I am paying because of the government levy. My view maybe it will be only 100. Maybe somebody wants to be extra conservative, we would take a position that it is 118 and not 100. I would tend to believe it's 100.
In any case, what is charged to the profit and loss account will be 100.
Correct, correct.
18 will go as
a liability and asset.
in case of third case also, if it is given directly, but on payment year expense for they return for 100.
Correct, but 10 rupees is already paid, no? Liability means you have already shown, and if assuming you don't pay TDS, then it would be disallowed under 48. 43 में disallowance नहीं आएगा. So now what is net payable to the party is only 90. 10 rupees you are saying I will pay in the form of TDS. Timelines.
So these are positions taken or there are certain.
So these are accepted positions taken by a lot of bigger firms, a lot of professionals. This has been discussed in a lot of professional forums also. And I think these are very well accepted. I don't see a challenge in this positions. Timelines to be checked with reference to bill date or booking date. So generally in a lot of cases you would see a scenario that bill comes in factory till the time it reaches HO, it is already 1 or 2 months. Booking happens once the bill invoice is received in HO. The time limit has to be calculated from the day when it actually moved in the system or when the goods or services were rendered in that factory. Ideally, it is from the date of factory. However, it will all depend on your accounting. How are you accounting that transaction? But very technically speaking, it is from the actual day of receipt of goods or services at the factory level and not the invoice level. A lot of people what they have done is on 31st of March they have issued checks trying to state that कि भाई मैंने check दे दिया, he has not deposited, he has deposited by 30th of June. In such scenario, 43B provisions should not apply. RBI case, yes, provisions would not apply. However, you should have that OD facility or banking facility as on that date. It is supported by funds. ऐसा नहीं है कि भाई bank OD facility is 5 crores. I have issued checks for 25 crores. Logically also, it will not sail through during the course of assessment. And whether the provisions would apply to retention money or I think I'll skip this in the interest of time. This is now settled by the Supreme Court decision in case of checkmate services. So any employee contribution which is received has to be deposited within the specified timeline. If you are not depositing, then this would be disallowed and would be considered as income. However, only one causa for all of this. Assuming the payment is delayed by technical glitch at the website of EPFO or something, whether you could take a position that I will not discover it, or assuming I have not applied for the registration. With the time I don't apply for registration, I cannot make payment. So I have collected from the employee, and I have started my business from 1st of April. I have applied for EPFO registration on 30th of September. For the first 6 months, I could not have done payment on time. Why? Because there was no registration in place. For this first 6 months, whether you will disallow, I would say a practical difficulty. I cannot make payment, so I will not disallow. It will depend on position to position, but RBI case because there is no mechanism to make payment offline. I have to first apply for registration. It's an act of impossibility. Based on that, the position could be taken. Penalties and fines. Again, something which is very critical. I think while imputing your business income. Now, explanation 3 to section 37(1) has been added. 3 links have been provided. 1. And if an expenditure is incurred for any purpose which is an offence or which is prohibited by any law in India or outside India. So any expenditure that you do which is offence or prohibited by law in India or outside India, then this would be disallowed. If you are providing any benefit or perquisite in violation of any law or regulation or guidelines. So for doctors, there are specified guidelines which have been there. If you are providing any freebies to doctors, then these are like benefits and perquisite as per those guidelines, and accordingly, any payments that you do to the doctors would not be allowed as deduction to the person who is providing that benefit or perquisite. And finally, to compound an offence, whether in India or outside India. So the first clause says that it has to be an offence or prohibited by law in India or outside India. So we have a Supreme Court decision way back where it says that if the liability is compensatory in nature, then it is deductible. If it is penal in nature, then it could not be deductible. Earlier, there were a couple of rulings, especially in case of pharma companies, where they were making a lot of payments to US FDAs outside India. And they were saying this is violation of the norms under the US FDA guidelines, not as per the Indian law regulation. Because these payments are outside India, this is violation of foreign law, hence 37(1) explanation should not apply. This position has now been overruled. It says any fines or penalties violation of any law. In the entire globe, अगर आपने if you have violated any law of the globe, then the expenditure would not be allowed as deduction. Second is the controversy of Dr. Freebies, where it says that the benefit or perquisite has been provided, which is in violation of any law or guideline. It does not prescribe which law or which rule, which regulation or which guideline. It is very open-ended. Any law, rule, regulation or guideline could be architect, could be CA, could be anything. If anything has been provided in violation of this law, then the expenditure would be disallowed. You need to understand, read all this law, rule, regulation, guideline, could be n number of guidelines. Now again, this controversy is settled by Supreme Court decision in case of Apex Laboratories, where they have said that nothing doing any benefit or perquisites that you provide would be disallowed. Finally, to compound an offense in India or outside India. So to buy a peace settlement, instead of going with the case, arguing that case, I say that I want to compound an offense. Let's close this chapter. I am not accepting it, but I just want to close this matter. So whether there is a difference between compound of offense and compounding fees, and whether admission of guilt is required, whether I should, as a person, admit that yes, I am guilty and now I am compounding that offense, or I can just say that I am buying peace. I don't want to go into litigation. I am paying this fees and just closing this chapter. So disallowance is in which case? Technically, you could argue still that if you are buying a piece, not admitting guilt, in such a scenario, the provision should not apply and still the amount would be deductible. And you have a couple of decisions on this to support this argument where they say that there was some technical violation without committing an offense and I paid compounding fees allowed as a business expenditure. In case of Reliance shares and stockbrokers, it says that I have paid without admitting guilt to an evidence of an offense. So there was an offense as per SEBI. They say that I am not admitting guilt, but I am ready to pay this off. They say okay, then this would be allowed as an expenditure. Similar case has been there in Sun Pharma's case where they have said that any settlement payment that you have done, so there was a US FDA challenge, the third party claimed some IPR infringement, they paid some settlement amount to third party. They said to me, you are not admitting guilt, but you are just settling that amount. So this is payment without admission of guilt or offense, not covered under any specified provision, would be allowed as deduction. So some decisions that could be of help. I think generally all your income tax, interest, TDS, late fee would be like compensatory in nature, would be allowed as deductions. Only last paid for violation of US FDA norms. I think this is something that I would like to discuss because this is in violation. So if this is under the FDA norms of the first name, if US FDA norms, there is a law of that land, and if you are paying, then this would be disallowed. But if it's only a rule and regulation, if it falls under clause 2, then clause 2 doesn't say it has to be in India or outside India. In India, outside India is only first and third. That differentiation factor has to be kept in mind. So if there is rule, law, regulation, guideline of third country, and if I am paying something, then still that could be claimed as a deduction. Maybe it's 11:35. Yeah, we'll continue for 10 more minutes. We'll take few question answers if there are there. Next speaker is already here. Non-deduction of TDS. I think what we need to discuss is the year-end provisions. Whether on the year-end provisions tax has to be deducted or not. Generally, a lot of people have been taking a position that these are all year-end provisions without identification of paying. These are ad hoc provisions. First of all, two questions emerges. If these are ad hoc provisions, whether this would be allowed as deductions or no. And if these are not ad hoc provision and if still the pays are not identifiable, whether the deduction of taxes required or not. There are some tribunal rulings to your safety where they say that Just for accounting purpose, if you are doing some provisioning at the end of the year, which are reversed on the next day, on the first of the next year, and if the pays are not identified in such a scenario, there will be no liability to deduct tax side source. Concept is that if you are doing provision and if the pay is not identified, then there is no requirement to deduct tax side source. But if pay is identified, there is requirement to deduct tax side source. This could be understood in the form of example where say rent of March, you generally know the pay, generally know if what is the amount that has to be paid. So amount is known, pay is known, then tax would have to be deducted. Interest on cumulative transferable bonds. So you know what is the amount that has to be paid, but the pay is not known because the bonds could get transferred to any person between the date of 31st of March to 30th of June. In such case, you will do provision in the books of accounts, but position would be taken that no TDS is deductible because I don't know who the pay is. And based on the rulings that we just discussed earlier, a position can be taken. Commission on net sales by distributor to the ultimate customer. So in this case, I know distributor is the pay, but what is the amount I don't know because I need to compute the net sales figure and then on that net sales percentage has to be given as commission. So amount is not known, pay is known, but I do an add-on provision, still TDS provisions would be applicable. And finally, there is some contract work which is going on. There are multiple vendors who are doing the activities. I do a lump sum provisions in my books of accounts, trying to say that this much expenditure is to be incurred. Neither the amount is known, neither the pay is known. It's just an ad-hoc provision which gets reversed on 1st of April. Then again, there will be no liability to deduct tax side source. So year-end provision, I think these are some basic help that you could take. On reimbursement of expense, there is no requirement to deduct tax side source. If you could prove that there is an actual reimbursement and there is no profit element which is there. Like he paid 100 and I reimburse that 100 rupees to him. In such a case, there would be no requirement to deduct tax side source. Also, if instead of 10% of tax I deduct at 2% under 194J, I assume that this is technical services under 194J, but department argues no, this is 10% under 194J. Whether there could be a disallowance? No, there cannot be a disallowance. Once the tax has been deducted, whether at actual rate or lower rate, to take a position that tax has been deducted, there can be no disallowance. And assuming tax is not deducted, still there will be no disallowance if by virtue of second provision it says that if the tax is paid by the recipient. If the recipient offers this is an income and you file a specific declaration in form 26A, then probably there will be no disallowance in your hand. However, the liability of interest under section 201 would still continue. Capital expenditure and revenue expenditure, I think this is again something which would be very critical for you to analyze whether the expenditure is allowed or not allowed. What is capital expenditure has not been defined. The principles will emerge from the guidance note which is issued by the institute. What are the parameters that one needs to try and test for classification of an expenditure? Generally, the concept is that if the expenditure that you are doing is creating some asset which would generate some additional source of income or which is going to give you an enduring benefit at subsequent point of time, if yes, then that would be a capital expenditure, otherwise it would be a revenue expenditure. A lot of cases come up where people are doing some WIP and then they scrap out the WIP. Whether in such a scenario, scrapping of WIP would be capital expenditure or revenue. There is a High Court decision in Binani Cement where they were doing some project and suddenly they found that no, this project is not viable. They'll have to scrap off the project. Under the scrapping of that project, the entire cost was debited to profit and loss account. In such case, they said the entire amount would be disallowed because there was no enduring benefit that the SSC got by doing this project. And in the course of this business activity, they had tried to build this project, but which eventually did not materialize. And accordingly, the entire amount will be allowed as deduction. Abandoned. Software expense, I think nowadays a lot of companies are investing in technology. Software is something which is very essential in the entire business activities. So any expense that you do on the upgradation of software, if it only improves the efficiency of the work, When it does not create a new asset, then probably it is not capital in nature. But if it creates a new asset, then it is capital in nature. So you need to look at the nature of expenditure, what the benefit is derived from that asset, and accordingly take a position. If there's no other application control software like Microsoft Excel and all those things, then you can claim that as a revenue expenditure, need not be capitalized. And assuming you are capitalizing it, you could claim if these are computer related softwares, then you could claim that at the rate of computer itself, higher rate of depreciation. We had also, I think, few months back when I was in tribunal, in one of the case of NSE was developing some software. So again, that was a project. They were trying to develop some parallel software for them for real-time data. And in that case, then they eventually stuck. They had to abandon that project because there was much better software which was available at that point of time, and that amount was also sizable in nature. So they written off that project, trying to say now the newer technology has come, and accordingly, whatever software we have developed is now not no more usable. So we are writing off this software. That software they claimed as revenue department are no, this is capital expenditure, we will not allow this. Revenue is nothing doing, this is revenue expenditure. This is just change of technology has to be allowed as expenditure. Maybe depending on the factual matrix of each case, you have to evaluate whether this is revenue and capital expenditure. Depreciation, generally it is allowed on WTV basis unless you are in the business of power generation or distribution of power. You are option to charge depreciation on straight line method. Otherwise, it would always be the WTV method. The one of the major conditions is that asset must be wholly owned or partly owned by the SSE. It need not be registered in the name of SSE. So even the registration is in somebody else's name. But if I am the owner, so generally it happens in the case of car. Car is registered in the name of director. Beneficial ownership is in the name of company or the partnership firm. In such a case, the depreciation would be allowed to the company or the partnership firm. The asset can be owned so to the proportion of the ownership that I am holding, that much depreciation is that what I would be entitled to. Classification of the asset is something which is very critical because the rate of depreciations would be very different. Now the rate of depreciations have been capped, but earlier the depreciation rates were up to 100%. So the correct classifications of the asset was very critical. Assuming the asset is used for business purpose and also for personal purpose, then the allowance of depreciation has to be restricted to a justified sum, trying to say that 40% was used for the purpose of business and only 40% of depreciation allowance would be allowed. Balance 60% would have to be disallowed. In case of succession of business, like business lump sale, demerger, the maximum depreciation that would be allowed is, assuming no succession would have taken place, fifth proviso to section 32, which says that entire year's depreciation cannot exceed between the two entities, transfer company and transferee company. Both put together, whatever was the total depreciation has to be distributed between the number of days for transfer company and transferee company based on which the asset was used by those entities. We have specified explanations under section 43(1), explanation 1 to 13, where different scenarios have been envisaged, and in such different scenarios, they have said that what would be classified as the actual cost. Like one of the examples sir raised that assuming cash payments are made. In that case, there is a specific explanation which says that your actual cost would be restricted. Anything above 10,000 would not be considered as the cost of the asset. So explanation 1 to explanation 13, all the explanations would have to be looked into. Assuming there was some asset which was used for personal purpose, then now it has been considered as business asset. Now because we are showing this as professional income or business income, then what is the value at which the cost has to be considered? Even that has been described. You need to look at specified cases and which limb you fall. Assuming there is an interest, you have borrowed money for purpose of acquisition of that asset. Then the interest from the date of borrowing till the date the asset is actually put to use, the entire interest would have to be get capitalized. However, this would be again subject to the ICDS provisions. ICDS provision says that there has to be a qualifying asset. So subject to the various provisions, you need to look at the interplay of section 36(1)(3), the ICDS provisions, and explanation 8 to section 43(1). And obviously, there will be foreign currency adjustments. So assuming there is an asset that has been come from outside India, there's a foreign exchange fluctuation which is there, then that on payment basis, that foreign exchange fluctuation has to be adjusted in the cost of asset. So depreciation of goodwill now, goodwill everybody needs to claim depreciation business with security. Now the position is that goodwill is considered as a capital asset but not a depreciable asset. So there will be no depreciation would be allowed on goodwill, though it is considered still considered as a capital asset. And what is the adjustments that to be done? So Rule 8AC has been notified that assuming you have goodwill in your block of assets, then there is a particular mechanism in which the block of asset has to be adjusted. Depreciation on intangible assets. The terminology is any other business or commercial rights of similar natures. In few of the cases, even non-compete fees that has been paid because it is capital in nature. In case of medical, they have tried to claim a depreciation on this. In certain cases, non-compete fees has been claimed as revenue expenditure also, based on the specified facts. And in those specified cases, even non-compete fees has been allowed as revenue expenditure. So based on your facts, assuming you are treating it as a capital expenditure, then there is a possibility of you to claim a depreciation on that. Assuming you are acquiring the client, so because of the arrangement, I say that whatever clients you have, I acquire those clients. From now onwards, I would be rendering the services, and for acquisition of that client, I pay a lump sum amount. Now, because there is an enduring benefit which is there, this would be like a capital expenditure, and I would be entitled to claim depreciation on this. There are other decisions on intangible assets. What would be considered as business or commercial rights of similar nature? Cessation of trading liability 41.1. Mahindra and Mahindra Supreme Court decision has already cleared a lot of ambiguity which was there. So any liability for which expenditure has been already claimed, which is subsequently written back in your books of accounts, would be subjected to tax under 41. So finally, the takeaways from the today's presentation of the talk that I had, business, what is subjected to tax is the real business profits. There would be no concept of notional profits which are there in the chapter 4 part D. There is no hypothetical or artificial and theoretical income. Only the real income, your income less the expenditures that you incur, the net profit is subjected to tax. Head of income must be carefully decided. As we saw, your same income could get classified under house property, could get classified under capital gain, under IFOS. We need to be very clear whether this income is business income or IFHB or not. Revenue needs to establish and receipt is taxable income. So receipt could be taxable receipt and this could be exempt receipt. So which receipts these are? So that needs to be clearly established. Expenditure is incurred for the purpose of business. So if it is not incurred for the purpose of business, or if it is incurred for a purpose of business which is offense or prohibited by law, again that would not be allowed as deduction. For disallowing an expense, first of all, that expenditure should have been incurred and that expenditure should have been claimed by the SEC. Only then it can get disallowed. So if expenditure is incurred but not claimed by the SEC, then there is no question of disallowing because there is a suo motu disallowance by the SEC. Book entries are not conducive to taxation. So maybe in the books of accounting, as we saw for TDS, maybe you did accounting for provision, but tax liability is not driven by the books of accounts. You need to take the position whether actually pay is identifiable, whether actually there is a requirement to deduct tax at source or not. Business agreements cannot be related by the revenue. So maybe there will be some commercial understandings. That commercial understanding cannot be rewritten by the tax departments. Whatever are the actual transactions on the net basis, tax has to be discharged, and that is what the department has to assess. So I think I open the floor for questions if any. Otherwise, thanks for a patient hearing. It was great to share thoughts on the subject of business. Thank you once again.